The layoffs in the United States in January and February this year were the highest since 2009. This as per a Reuters report. More than a third of over 180,000 job cuts announced by US companies in January and February were in the technology sector. Take a look at our next report to know more.
According to a report by employment firm challenger Gray & Christmas, the number of layoffs in the United States in February alone was 77,770. Which is more than 5 times higher than the 15,245 job cuts announced the same month a year ago. Andrew Challenger, Senior Vice President of the firm, said, "Right now, the overwhelming bulk of cuts are occurring in technology. Retail and finance are also cutting right now as consumer spending matches economic conditions." Thousands of jobs have been eliminated at big tech companies including Amazon, Facebook's parent Meta, Google's parent Alphabet, Microsoft, PayPal Holdings and others this year as a result of the uncertain global economic outlook. James Tierney, Chief Investment Officer at asset management firm AllianceBernstein, said the layoffs that many of these companies are announcing are welcome to investors, sort of right-sizing the cost of structure. Rationalizing growth is being rewarded in the marketplace. That even as shares of Alphabet, Microsoft, Amazon.com and Meta have risen between 6% and 54% so far this year after plunging between 29% and 64% in 2022. On Wednesday, Federal Reserve Chair Jerome Powell reiterated his message of higher and potentially faster interest rate hikes, which could lead to more job cuts. Markets have now increased their bets for the Fed rates to peak at or over 6%, from about 5 to 5.5% just last week. Now, the potential for US interest rates to peak at 6% is sending shockwaves across the financial system as more and more investors consider the consequences for various asset classes. Indeed, those expectations for higher rates pushed the bond market to price in a higher chance of a recession because the Fed might have to raise interest rates again to slow down inflation and the economy. 2-year rates on US Treasury bonds jumped about 5% for the first time since 2007. Worryingly, the yield on US 2-year bonds was higher than that on US 10-year bonds by a full percentage point for the first time in over 4 decades. In 1981, then Fed Chair Paul Volcker was engineering hikes that broke the back of double-digit inflation at the cost of a lengthy recession. Inversions of the yield curve happen when short-term interest returns are higher than long-term rates. This is usually a sign that a recession is coming soon. Ken Griffin, the CEO and founder of hedge fund giant Citadel, says that a similar thing is happening right now. "We have the setup for a recession unfolding as the Fed responds to inflation," he said. What that means is the Fed is engineering a recession which will push companies to announce more layoffs as they cut costs to look profitable to their shareholders. A Reuters report reflects that this is the case already. US firms announced plans to hire 28,830 workers in February, down 87% from 215,127 a year earlier. Bureau Report, WION World is One.
WION is now available in your country. Download the app now. Get all the news on the move.